Yes, I've started the recording. Welcome to this session of Wealth Mentor. Today we're going to be looking at the entire system from scratch. I'm going to literally break down the car into several different bits, into components, so that you can understand it, know exactly how to use it, analyze really, so you can really analyze now. Again, for those of you who just arrived, the goal is to get you to be independent and analyzes. Hi, good evening. I didn't see that. Oh, you can't see my screen just yet. I've just started sharing my screen. I cannot hear any sound. Can anyone else hear me? Okay, good. Then Amatola, it's got to be a problem your end. You may need to switch off your computer, switch it back on, come out of GoToMeeting, or however. Uh, but hopefully you can get that worked out. Um, so again, objective here is to get you all to be independent analysts. I have a saying in Wealth Mentor and Basilica Invest. The key to being a successful trader is not to approach the market as a trader. Never come to the markets to say, "What am I going to trade today?" That's a sure way to lose money. You come to the market as an analyst, never as a trader. Don't come looking to click buttons. It's real easy to be a trader. All you need to do is go to this corner here and buy and sell. That's a gambler's game. The first thing you want to be is an analyst. If you don't like what you see as an analyst, there's no trade. You saw me today, there were several things I passed up on. The only thing that I really was involved in was USD ZAR because it was, to me, it was a short trade. It was real clean analysis. It was really simple. I saw all my rules and criteria were met. There was no hardship in getting inside of that trade. With other trades where I'm like, I'm not sure, do I really want to commit my hard-earned cash to that kind of trade? And some people might say, well, it's only a small amount of money I got in my account. I'm willing to lose it anyway. Be disciplined even with a small amount of money. Because if you're not disciplined with a small amount, I will assure you, you won't be disciplined with a lot of money. So the first thing you want to do when you approach the markets, when you open up your charts, when you get on your screen, is you have to put on your analyst hat. You are there to just see what is going on, not to make something happen, not to, um, you know, try and squeeze a trade out of the market. You're just there to see if the conditions are conducive to a profitable trade. Once you've analyzed, and this is the focus of these lessons that I've been taking you on is analysis. I do want to do some sessions on risk management. I think it's absolutely key that I do lessons on risk management. But once you've analyzed and you are sure of your analysis, the next key to being a successful trader, and this is absolutely pivotal, is risk management. Um, and by risk management, we're not just talking about managing how much you lose. That's that's ultimately what risk management is all about. Risk management is managing how much you'll lose because trading, you will always lose trades. You're always going to lose a trade or so. It's about managing how much you lose, but also more important than that, or equally as important than that, is managing how much you gain as well. For example, right here on this trade, if I when I'm entering, which I'm entering gold long tomorrow or tonight, when I'm entering this trade, here is my risk. From here to here is my risk. That is a 25 pip risk. I don't want to go for a 25 pip gain. That will give me $305 potential loss for $305 potential gain. Now, let's say I win that trade doing this one-to-one risk to reward system. If I do that and I lose the next trade, I've wiped out the profits of this trade. So what I want to do is give myself a few trades that I can lose by making sure I go for high rewards to risk. That means plan your trade your plan. This would be my reward. Now, can you see for a 25 pip risk, I got 133 pip potential gain. That means if I lose $305, my potential gain on this trade is $1,626 of profit. You can also see I've risk managed My risk management parameters, and if you want this tool, by the way, that I've got set up on my charts, it will only work on MetaTrader. No other software will allow you to use this tool. It's a custom design tool that will only work on MetaTrader, that calculates risk for you. It knows exactly how much is in your account. It knows your equity and your leverage, and it helps you calculate your risk. So right here, I set my risk at 1%. So 1% of this particular account I'm using is $305. My risk is set to 1%. My position size, therefore, should be one lot 22, or $10.20 to $10.22 to a pip. So about $10 a pip in this particular trade, to gain them that kind of reward. So again, you want to approach the market first as an analyst. You're there to analyze. Then you want to approach the market as a risk manager. A risk manager says, this is the amount of loss I'm willing to take, but this is also the gain that I want to achieve in the particular trade. Once you've done all of that, then you can be the final stage, which is a trader. Okay, so essentially my first aim here is to teach you how to be effective analysts. So I'm going to show you exactly what I do from the perspective of a professional fund manager. I'm going to show you what I look at, what I look for when I'm opening my charts. Let's do a case study on a particular trade we took today, which would be the trade of the day. It was the only trade of the day, which was USD ZAR. A great trade. You can see I set my risk on this trade. I posted this trade to the group. If you look at our signal service here, and you'll see, in fact, sorry, I posted an analysis. Sometimes I'll post an analysis to show you guys how I'm thinking, and sometimes I'll just make it a straight signal. But right here, no, right here was the trade before it had played out. There, from here to here was the risk I'm willing to accept. This particular box was the risk I'm willing to accept. I knew at some point it will retrace and give me a fresh entry and a drop. I expected the drop over 2 days, to be honest. I didn't expect a straight drop today. But news and fundamentals had carried it quite well. We had so that was somebody else just arriving. Sorry, so that was the trade, and look how it played out, exactly as planned, to my exact take profit target. It went to the exact take profit target, which was this line here. My accepted risk on this particular trade, my entry was right here. Once it peaked back into my zone, that was the entry I was willing to accept. My stop loss, if you've got your microphone on, please turn it off. My stop loss, I can hear somebody's microphone on. Okay, just turning you off there. So my stop loss was just here, which in this case, my stop loss was well, it's USD ZAR, so it's a bit different, but it's a 56 pip stop. And my reward in this trade was 234 pips reward. Just a really good trade. That's a solid trade, okay? Now, we're going to look at why did I jump into this trade. We're going to analyze USD ZAR. By the way, USD ZAR is probably, and I don't want you to, I don't want to say this and then you guys say, well, this is the same for you, but it's my favorite currency to trade. Is actually my favorite currency. I've had my most profitable trades with USD ZAR. Not ZAR JAPY or anything like that because the spread on those is too high. USD ZAR has been a comfortable trade for me. If you're not trading with Hot Forex and you don't have our zero spread account, I suggest you don't trade USD ZAR. We use zero spread accounts. So zero spread basically essentially means we don't get charged a spread, we get charged commission instead on the trade. Okay. Now, is everybody still with me? Everyone okay? So I'm going to show you how. Now, this is your analysis is going to be how you make money. If you don't like what you see, don't trade it. So first thing I do is I got a plain chart. I don't like all these things on my chart like stochastics, RSIs, or anything like that. I used to like stochastics, but they started getting on my nerves a bit. But I've started using instead just plain charts to analyze with. Um, I don't know why that indicator's still there. So I'm trying to get rid of this. Let's clean it up. That's weird. Let me set up my template again. It's gone. It's gone. Okay. There we go. Everyone sees this chart. What I'm going to do, first thing I do is I start picking out my horizontal levels on the chart. I don't know what I'm, sorry, 1 second, please. Has it? No, not dinner yet. Sorry, just trying to sort out my son. Okay, I'm gonna go ahead and close everything I've got open because it's gonna start slowing down the speed of my computer here. Let me close all my programs. Okay, cool. So the first thing I do is I define my trading range. Okay, now if you know how we trade, we use what's called supply and demand. Okay. We don't use, please don't mistake what I'm doing here for what do we call it? Please don't mistake it for support and resistance because it's not support and resistance. This is supply and demand. Now let me just get my laptop pen here and just so I can draw on this screen. Now, supply and demand operates like this. Market makers Forex market was heavily believed that you could not manipulate the Forex market. I hope everybody's keyed in, everyone's paying attention because I actually do want everyone to make money. Um, for market makers have for a long time dominated the Forex market. It operates between major exchanges. You've got the London Stock Exchange, you've got the New York Stock Exchange, and you've got the Tokyo Stock Exchange. Now, all of these operated on the stock market for a long time. But if you know anything about the Forex market and the stock market, they work in line with each other. In fact, sometimes if you want to know the strength of the pound, you can look at the FTSE. If you want to know the strength of the dollar, if you want to know whether to have a bullish or bearish dollar bias, you can look at the Dow Jones or the Nasdaq or any of those indices and stock values because stocks and currencies are heavily correlated. Now, because of the Forex market is a $6 trillion a day industry, I'm talking $6 trillion. Sorry, my pen's a bit dodgy right now, so that's supposed to say trillion. Because it's a $6 trillion a day market, many people believed it was too large to be manipulated. Stock market is easy to manipulate because if you own billions of dollars of shares, the stock market is only worth billions. So you could easily move the stock market, which means you can entice people to go in one direction while they're going net long, you can manipulate the market. Once it reaches a particular level, you can hold short positions up here, and all you do is wipe out all the stop losses of everybody who's net long, and then you've made your profit. And that's basically you as a company could pump liquidity into the market and manipulate the market. This is why there's huge issues with people like Warren Buffett. Warren Buffett, for example, cannot write anything on Twitter about the stock market because he's too big of an influencer over the market, and if he sneezed, the stock market could collapse. That's how small it is. It's also centralized. Because the Forex market is decentralized, it was believed that it could not be manipulated. How wrong we were. It can absolutely be manipulated, and it's manipulated using something called supply and demand. Okay, supply operates like this. Basically, and I'm going to put it in small money values so that we can all understand it. Um, let's say the market maker is net long. Long, by the way, means that he's going to buy. Let's say the market maker is net long, and he's net long $10 million. And you or the net value of the trader, let's say the net value, that means all the traders are cumulative all over the world, including hedge funds and other such corporations. Let's say they were all net short $5 million. Now, short means sell. They were going to sell the market, but the intention of the intention of the market maker is all that matters. We cannot drive the market makers do. Okay? Their intention, now intention is expressed, market maker intention is expressed intraday, intra-week, intra-month. We see this basically we see this market cycle on any time frame. I am an intraday trader. I love getting in and out of positions in the day. If you want, you can do it intra-week. The same observations that we see intraday also operate intra-week and intra-month. The only thing is it requires a stronger psychology, more patience and time to trade these higher time frames. I don't have that level of patience just yet. Okay, so let's say they were net long 10 million. That means their intention on the day, we're looking at the day, their intention on the day was to drive the market up. But if you know anything about betting, if you know anything about Vegas or whatever, if you're going to place a bet, a $10 million bet that something's going to happen, you need somebody to take the opposite side of your bet at least break even for it to be a worthwhile bet. Well, that's not worthwhile, but you need them to put a bit more. Let's say what they're waiting for is 15 million net short, then they'll make a nice cool 5 million from wiping out your stop losses. Okay, I hope everybody's with me. So they're driving the market up. The net short value, the opposite direction is not they're not biting. They're not. It's not enough to make it a worthwhile bet. So again, Vegas always wins. That's the first rule of Vegas. The house always wins. House always wins. Let me tell you something. The Forex market is rigged against you. This is why for years I hear students all the time saying, I've tried trading and all I do is keep losing. It's because the market was designed to take your money away. And because most people are gamblers, they'll keep refueling their account over and over and over again. And they'll keep taking a butt whooping, believing that they're going to make it. And that's a gambler's mentality. You're just blowing money now. So we want to stop that. So everybody's net long. So what the everybody's net short. Now this is a good thing for the market makers. So they'll throw something. They'll throw a nice pattern that you read about on babypips.com, like a silly triangle or a trend line or a support and resistance break or something to entice you to go short, fully well knowing that their intention is long. They'll do what we call Judas swings, JS, Judas swings. They will drive the market. So you'll see the market, intentionality is net long. You'll see it start to give short, like ABCD structures. They'll validate any structure you've read about in a textbook to entice shorts. Or they'll make the market, maybe you're long, they'll make the market hang around long enough that your psychology just gets messed with. Has that ever happened to you? Happens to me. It's happened to me quite a lot where I thought, the market's hanging around, guys, I'm getting uncomfortable, it's a bit too slow. And then you get out and then boom, the market goes exactly where you thought it would go at the moment you got out. Because again, they know your psychology. Another thing they do is they drive the market. Judas swings usually happen in 3 moves. A, B, C. Usually happens in 3 moves because 3 is a superstitious number. 3 is a habitual number. If you see a trade going against you in 3 swipes, you're going to promise yourself by the 3rd swipe you're going to get out. And then you're going to hold on, trying to bring the trade back to break even before you get out. And you're going to see it drag down again and like, oh, what's going on? What's going on? And then boom, all along you were right. Remember, this thing is rigged against you. That's why the moment you open your account, the first thing you must determine, is directional bias. That is the first thing. And it's not using moving averages or anything or MACDs or anything like that. You're determining directional bias number 1 by looking at supply and demand. Remember, all of business works by the law of supply and demand. You are determining directional bias by looking at the law of supply and demand. The market doesn't move by support and resistance, it moves by supply and demand. Forget trend lines, forget triangles, forget um, all the turtles and different animals that we've given sharks and dartleys and harmonics. Forget all of that. The market moves by supply and demand. Everything you see by trend lines, head and shoulder patterns, Gartley's triangles, all of that is the effect of a cause. Okay? It's all the effect of a cause. The cause itself is supply and demand. This is not support and resistance. This is supply and demand. So it's similar. It can have some similar effects. In fact, support and resistance itself is based on supply and demand. And when you start to see it in the markets, we call it seeing the matrix. All of a sudden, you start to see it. Then you can grab a hold of it. So your first job is to find directional bias, and this is done by finding out where the supply and demand zones are. Okay, so I could, like, for example, and I'll show you this in fact with USD ZAR. Once you've determined directional bias, your second job is to look for confirmations in the forms of market structure breaks. Okay, for example, let's say I can see a demand candle right here. This is the candle of demand. Okay, and I saw prior to this, the market did this. It swung high by a and then there was a structure break. The next swing broke the previous swing structure. And then the market came back to the point of origin where the demand zone was. And I'm going to teach today, how do we find supply and demand zones? I'll show you. Well, the market came back. I can say, based on the fact that we took this structure high, yeah, that we should look for another structure that exists somewhere in the past that the market is looking to take next. And that will be my third point. Determine your target. Determine, both your point of entry, your POE, and your target. Once you've done this, you risk manage, and then you trade. I need to go back to GoToMeeting. Is everybody with me? Is everyone with me? Are you ready to see it on the charts? This is, by the way, the same thing we do every day. I'm looking for ways to refine it, the technique, even more and more, so it can be simplified. But that's the most simple I can make it for now. Determine directional bias. This is what we're doing first in analysis. We are determining the directional bias. Now, because I'm an intraday trader, I want to find the intraday directional bias, but I always start at the higher time frames. Okay, so let's have a look. I can first of all see, now remember the old support and resistance operated like this. I'll tell you, mark up your support and resistance on a chart, and you'll do something like this. Oops, sorry, I did not mean to do that. Let me zoom out. You would all zoom out. This is how I used to teach. Almost ashamed of the way I used to teach now. And that would be support and resistance. You'd be like, oh, okay, so price went to this resistance. Now it's coming down to support. Then it's going to go up to resistance. Yeah, no, it's just all wrong, because now we can say, well, we should be buying because we can see wicks. All these pins are showing up. So price is looking to take on high highs. And what are the most relevant pieces of this? The most relevant lines right now, this line is no longer relevant here. Why? Because currently the market has broken the previous swing structure. So this structure here, when the market swung up, It broke this structure. When it broke this structure, the next target, once it broke this structure here, when the market broke this high right here, the next high it was looking for was here. It broke this high. It broke the high of this candle, pulls down. So we can ascertain from the monthly USD ZAR, the US dollar is very strong against the South African rand. In fact, since 1993, it's done nothing but rise. I mean, if you had a rand in 1993, sorry for you today. It has depreciated drastically, the ZAR, since 1993. Let's delete all of this. The lines that are relevant right now to me is this high right here, just here, and also this low right here. Now this is kind of hard to see on the daily. It's a bit tricky to see on the daily. But I can see that the range the price is trading in is here. Now, again, it's a bit tricky to see, but this is a swing low, this candle. What the market did was it went up, formed a swing low, went up. That was a swing low there. This swing low, this red candle that formed the swing low, the reason why it's a swing low is it because it has two candles next to it. You see these two candles, let me put a dot over them. These two candles next to it do not break its low. That's what makes a swing low. Okay, so it takes a trained eye to see it, but that's a swing low. So the market pulls up, swings low, rises up, comes back to the demand zone. Do you see that? It swings up, swings low, swings all the way up to here, comes back to the demand zone, but in so doing, it broke previous structure. What does that tell me? That tells me because structure's been broken, we're looking to rally higher again. Okay. However, you might also suggest there may be a little bit of I may put a little bit of a but in this here, because you might also say, well, look, market rallied up, but it broke lower structure here. So you might also say, well, this structure is broken. It's going to become clearer as we drill down time frames. So I can't make a conclusion just yet. It will become clear as we drop down time frames. Is everyone still with me? Everybody good? Okay. I'm going through this as slow as I can. Today's lesson may run over just a little bit because I'm trying to give you guys the juice from the beginning. Now you can see this line could have been better drawn on the weekly. If I look at it on the weekly, here it is. This is what I'm looking at. Okay, I'm looking right here at this low. This is a weekly demand area. Now, how do we define demand? Okay, how do we define demand first, and we'll look at supply. When the market, say the market was dropping down to a support, okay? In this case, my blue candles are bullish, my red candles are bearish, okay? Say the market was dropping down to a support or a level, sorry, not support, but a level that I determined to be demand. Let's say it was dropping down into previous demand. And then it took off again. When it takes off, the last red candle, the last bearish candle before the market took off, becomes the new demand zone. Essentially, what I'm saying by getting that red candle is if the market pulls back into the zone, it's going to take off again. It's these demand zones that we call money boxes. This is where all the liquidity is. This is where all the market making behavior takes place. This is where you see the most consolidation in any market. It's around these money boxes. When you can find the supply and demand zones, you found where all the liquidity is. You found where the money is revving up to take off. This is where directional bias is determined from. Now, in this case, if we look at my chart, the market has been rallying up. It's been in demand for a long time. Yeah, it's been in demand. Each swing point, can you see this swing point here? The red candle before it is a demand zone. Okay, see how the market rallies up, doesn't quite pull all the way back into the zone, but takes off. Then again, we get another demand zone formed by this red candle. In this case, the market took off, came back into the demand zone, and took off again. Each time the market takes off, it's forming new demand zones. Every single time. Do you see that? Market dips in, takes off, dips back in, takes off, market structure break, dips back into the zone, takes off. New demand zone. If I stretch this demand zone out into the future, see what happens in the future? From this candle, market took off, never returned to this demand zone again. This is the zone where the money is. Market finally comes back to the zone, gives us 3-4 weeks of buying, comes back to the zone, buys again, comes back to the zone, buys again. This is where the money's made. Because that might not look like a lot, but that's like 2 weeks of buying, 2-3 weeks of buying in these zones. If you drop down to a 15-minute chart, that's about 500 pips each time that market keeps taking off and going up from this one demand zone here. What happens in the future with the zone is the market finally breaks the zone and uses it as a supply zone. It becomes a flip zone. This is why we watch out for market structure breaks, because what the market did here was it broke the structure, the low of the demand zone, and used it as a supply zone instead. So it's been under that supply zone for some time. Now, instead of stretching this demand has effectively become supply in the future. Or what we can do instead of stretching it out into the future is we can simply just look at the current zones, because now we can ascertain that this market, since this trend line broke, this market is no longer in demand, it is now in supply. It's a supplier's game. Now, if it's a supplier's game, here's the first supply zone. In finding supply zones, we look for the last bullish candle before the market went down. So in the bullish direction, we look for the bearish candle. In the bearish direction, we look for the bullish candle. So here, this bullish candle here becomes a demand zone. Can you see how the market has not returned to this zone? I will tell you now, there is money, there are orders, smart money, there are orders waiting in this zone. I don't know why my pen doesn't write up here on my screen. It's really annoying, but sorry. There are orders waiting in here. Billions of dollars in this demand zone that hasn't been touched. What happened? The market dipped down and swung up again and formed another zone. This blue candle becomes another supply zone. What happened? Market dropped out of the zone, came back because there's money here. Remember, what market makers do is they will entice shorts. So they've enticed shorts. They didn't feel they made enough money in the enticement, so they did a Judas swing up to entice bullish action, and now they feel they've made enough money, they're going to run any stops that are resting there. Boom. And every single time the market rises and drops, it's creating new zones. This blue candle, again, is another zone. See this blue candle just here? Look what happens. There's money here. Remember, this is the money box, or the supply zone is also known as a money box. Market drops out of the zone, comes back to the money box. Didn't make enough orders, didn't entice enough people to sell, so comes back to the money box. Still didn't entice enough people so it entices some longs. They know their intention is south, but they're enticing longs around the money box, and then finally they run all the stops resting there and make all their money back. Is everyone starting to swallow the blue pill now? Did anyone see what I did, or is it confusing, or have I lost you? You fallen asleep? Talk to me. Good. Okay. Let me remove the chat and sorry, so I can constantly see the chat. So that's how market manipulation operates. So right now, let me ask you all a question. Are we currently just using your naked eye and we're looking at the weekly now? Weekly and monthly time frame zones are going to be the most powerful. All my lines are doing, when I draw these lines, the only thing these lines are doing is showing where supply and demand zones are. Nothing else. These lines are not support and resistance. Do not mistake them as support and resistance. These lines are just showing where the supply and the demand zones are. It's too big to draw these zones on the monthly. These zones are too huge. For example, right now, the current monthly zone is right there. See that red candle? Market peaks up, swings low, drops, goes up. When it did that, market took off, came right back to the zone, ready to take off again. Yeah, see that wick? Just nicely touching the money box, ready to go up. And there's a lot of consolidation around this money box right now. But oops, did not mean to do that. But right now, is the market in supply or demand? I want to know. Talk to me. Let's go back to the weekly. Supply or demand? Sandy says demand. Demand with a Q. Valentine says supply. Waco says supply. Okay. Let's have a look. I'm going to draw a few more lines here. This candle was obviously the demand candle. I mean, look at that. That was a clear money box. This red candle. Market took off. When it took off, it broke structure. See that? It drops back down. Here would have been an excellent position to buy from. Can you imagine buying this on a 15-minute chart? It's ridiculous what this does on a 15. Look at that on a 15-minute chart. It's unreal. I mean, from all the way over here, market, that's like mega pips. That's 1,102 pips from a weekly money box. Yeah, that's why we nickname them money boxes. Once you can find them on the weekly, you can take advantage of them on a lower time frame. But so right there, that red candle was our money box. Up here, can you all see that this blue candle is also a money box? So the market is trapped between two zones. If we look at it on the weekly, is that clear to everyone? If we look at it on the weekly, look what it's done. It's been pretty predictable. It's bouncing between these zones on the weekly. Okay. And each time it's forming new zones. I mean, look right there. This, if I can steal this here and make it this, that is now, this blue candle is the zone of respect. The market is dropping, coming back. It's not quite rising all the way to this one anymore. Look at that. This line now shows the consolidation created by this blue candle. Now, notice I didn't draw it at the tip of the wick. I drew it right here. I knew just the weekly body here of this blue candle will be enough to hold price. But look what it did this week. That same zone, markets dropped this week. So again, I'm not going to draw these boxes on this time frame because they'll look too big on lower time frames, but I will draw the lines that represent them. You can see right here, so lots of consolidation, lots of it. And essentially, what eventually happens is this candle becomes the demand zone, this red one, and the market just sort of jumped up and down from it. Okay, let's drop down again. And each time I drop down, all I'm doing is wherever I see this sort of consolidation, I know there's a zone. You see that? All of that consolidation is letting me know there are zones. This was the daily zone. This is why we said this phenomenon could be observed on any time frame. Any time frame. And you can see right here, the market broke this structure. Boom, showed some intention, broke the structure, pulled down, formed a zone. When it formed this zone, it broke this structure. Yeah? Even breaking that structure. Came back to the original zone. This thing wants to really look for the next target here. Okay. Now, can you see why I sold it today? This is the daily time frame and this was the daily drop. Can you see why I sold it today? Anybody? Why did I sell it? Why was I convinced that this would be a hard sell? Price went into a supply zone. Precisely it. It's supply, Sandy. Yeah, it's okay, it's coming into a demand potentially. But look at that. That was the zone. I mean, there's nothing else to it. It wasn't, and by the way, this zone stretches back as far as here. Market dropped, wicked into it, didn't make enough money on the initial drop, entices longs, drops fully. Market comes into some kind of demand here, rises back up. Once it rose back up to the same zone, it dropped again, market came to the same zone, boom. When it dropped, came back up, it didn't break the high. Now, yes, we've broken this swing high, which suggests to me, because this swing high is broken, the next high we're looking for to take is here. That would be my next target on a long trade. Okay. Now somebody said, well, that was news and whatever, but the news operated right within the zone. You could have seen what was coming in the news by looking at supply and demand. The news itself should favor governments and it should favor their own laws of supply and demand. So right there was the drop. Now I'm seeing a demand zone right here. See this red candle? This red candle forms some kind of demand. What I'm not liking is the low has been broken of this red candle. That's what I'm not liking. But that red candle does form some kind of demand. Now, it's clearer once we drop down to the 4-hour. This market is potentially going to rise intra-week. Now, on the 4-hour, we see the intra-week play. From here to here is a week. Now I'm starting to look at a point of entry for this trade. Because I'm on a lower time frame, I can now start drawing the zones. Can you see this wick? This wick exists because there's some kind of money box there, which, by the way, this tiny zone here would have been your stop loss. Even on a 15-minute time frame, that would have delivered from that low up, that move there delivered 111 pips just from the reaction from a 4-hour zone. Okay, that's the current daily zone is right here. If we were to find it on the 4-hour, that's your stop loss. Okay, that's what you're looking at in terms of a stop loss. And therefore, if we were looking for a target for the trade, because the trade has already taken previous structure back here, it rose up, took out previous structure, it came back down but didn't show any bearish bias, it didn't break bearish structure. We're looking now at the target on this trade being the next structure high up. That would be the target we're looking at. All the way to there. As a 4-hour position. Right now, correct, Sandy, it's in demand. So again, today's trade was a real easy one for me. It was a no-brainer. Today's trade was a no-brainer based on this this daily zone. This daily zone here made it real simple. What I did instead of using this big candle today was I used this. I used the actual zone on the 4-hour, the weekly zone. Once the market had dropped, wicked, I was ready. I knew it was going to drop, and that's my stop loss. I didn't need all of this huge zone as my stop loss. I could just use the 4-hour zone as a good enough stop loss and look for a 15-minute entry. Sorry, let me get my 4-hour zone again. I use the tip of, instead of using the whole candle, I use the tip. I use the tip. That's all I use for my stop loss. And I drew it on the chart. It's going to drop, but it will return back. And in dropping, it was giving us some clues. See this structure here? It broke it today. That's clue number one. Yesterday's structure being broken is a good key for intentionality. Then this structure gets broken again, telling me we're bearish. Then it returns to original structure. Stop loss here, entry right here. Boom, that was the trade. That was the money drop. By the way, once you get really good at this, that can be done in less than 2 minutes. Everyone good? Do you want me to look at one more? Is it fine if I look at one more, or are your brains finished? One more. Okay. And then after this, we can switch on our mics. You can ask me questions. Okay, so here's gold. Again, I love playing charts. Some of my guys like stochastics and stuff. I hate them. To me, it's analysis paralysis with stochastics. You start getting paralyzed. Oh, but the stochastic isn't lining up on the daily, and this isn't. It's just I liked it at a point, and I hate it. It's just I missed so many good trades because I was waiting for the stochastic to line up. Right there is our zone. Would everybody agree? This is our current monthly zone. Here's the demand zone. That's why gold rose. Here's the supply zone. From all the way back here, that's why gold dropped. It's between these, oscillating between these zones. Now I drew it here because I can see the most consolidation. I can see, can you see how the body of price just can't seem to break this high, and the low here just couldn't seem to break this low. Now, if you want, you can draw the basement, that's fine. And you can also draw the high up here. But all of this is just showing me where price is oscillating between right now. Okay. Then we drop to the weekly. On the weekly, zones. In fact, let me ask again the same question. Looking at the weekly, is price in supply or demand? Talk to me. Sandy says demand, supply, demand. Okay, let's have a look. Here is the current demand. See how price is just not breaking this low? It's not a support. It's not a support. It's a demand zone. That's what's happening. This zone. Entice longs, not enough money. Entice longs. Yeah, that was the demand. Is price currently in demand though? No. According to the weekly, price is in supply. Here's the supply. See how market's not breaking this high? There's a supply zone existing for right here. Once I draw my line, it becomes easy to find where the zone is. That's the zone. Price is just not breaking it. Now, notice it didn't come back to this zone. It's because a new zone was created right here. Price is in supply. There's no, it's not in demand. It's in supply. See, the reason why we're asking ourselves these questions this early is so we can determine our directional bias. Now, we may drop down a time frame and it could be in demand, but right now, weekly is telling us, and the weekly is a strong time frame, it's telling us we're in supply. Okay. Now, once we come to the daily, even though the weekly suggests we're in supply, once we come to the daily, we have a bit of a different story on the daily. We have demand. We actually have two demand zones. One created here. And you can also see structure break, previous structure break. You have a demand zone. You also have some kind of demand zone here as well. This red candle the market is in right now. And lo and behold, you have consolidation above it. Yeah? You have a nice bit of consolidation, a bit of consolidation above a daily demand zone. Okay? You also have previous structure broken. Yeah? And we're in both zones. Can you see where we've entered this zone, but also the wick has dropped down into this zone. So this trade looks ready. It looks ready. Now, the daily zone would be this. I'm not going to draw the whole candle. I'm just going to draw the bottom half of it just to show you. That's the zone. Let's see if we can find it on the 4-hour. It's still this red candle, this swing low. I'm not drawing the whole thing. I'm just drawing the base of it. But this is why we're experiencing this consolidation around this zone. Okay, now I found my point of entry. I want to look at where my target would be. Now we've taken this structure. We've taken this structure. The next structure we're looking for, and my target would be this swing high right here. So there's my point of entry. There's my target. Might I lose? Yes. Would a lose be worth it? Absolutely, because I've analyzed really well. The market can still be the market. News can come out and drive the market away. There's always ifs and buts. That's why we risk manage. So we manage how much we lose if we do lose a trade. Okay. Now, if I want to, I could either keep accepting the zone that I saw on the 4-hour, or I can just understand that the same thing is now being reflected over here. Now, let's have a look at this. See this red candle here on the 15 minutes? Now, can you all see that there's also some structure breaks happening? It's like showing you intention and now it's returned to origin. So tomorrow, if you want, I would suggest putting some long orders, put some pendings around here. T1, T2, and higher T3. We're looking at the market rallying here. If this level fails, this is our buy point, and the market will still rally. But I suggest putting a conservative target. You can get a huge, nice risk reward. Look at the reward. Look at this level of risk. This is the beauty of this philosophy, because you're only accepting small risk. That's your risk, but that's your reward. And you're only in the market for the day, intraday. That's why I like intraday trading. So I've got this set up the night before. Wait for US Open. Around the Tokyo range, we expect most Judas swings. We'll probably get 3 moves down to entice shorts. We get that at the beginning of every new day. Can you see this? Beginning of new day. Intention was obviously long this day, but what do? 3 swipes low. 3 superstitious moves low to confuse people straight into the previous day's demand zone. Market takes off. We've got a similar play happening here. Market has validated shorts. But imagine now everybody here is trapped. They're like, yay, the market's going to drop again tomorrow. This is what they're expecting. Anybody who's shorted from here is expecting the market to keep going down tomorrow. What may happen instead is all their stops get hit the next day. That's how wicked the market maker is. They validated all the ABCD shorts, all the Fibonacci patterns. They validated people short here, but they've trapped them in a day of consolidation. Boom, let's take them out tomorrow. With me? Have I boggled your brain? Do you feel like a scrambled egg? Or are you good? You still alive? So that's my gold call tomorrow. I'm liking gold. It's given me all my rules, all my setups, everything that I like. What I would then do before entering gold is open up your internet. What's it called? Open up economic calendar and make sure, I set my economic calendar I customized it by clicking custom to only show me what's important. We've got pound news coming out, inflation reports, but nothing US. Australian heavy news tomorrow, so we're good for gold. Okay, we're good for gold US. It should be quite a simple technical day tomorrow for the US dollar. Anything Aussie, if you're trading Aussie, which most people will be trading right now, there's news coming out of it on it now as we speak. In fact, sorry, am I looking at the wrong day? What day is it today? It's what day is it today again? All the days are merged into one for me. It's Monday. Yeah, so tomorrow, Tuesday, is already happened. Confused.com. So this is Wednesday. So Tuesday, nothing. Yeah, we're good tomorrow. Sorry. This is Wednesday I'm looking at. Tomorrow we're good. Nothing. So it's a technical day tomorrow. Trade it technical. It's pure technicals. This is a trade that I want to be looking at entering tomorrow. Stop loss slightly beneath the zone, a few pips beneath. High rewards. I'm looking for rewards up here tomorrow. I'll take some profit off the table around these points. But I'm looking for good rewards for this trade, good bang for buck. And again, if we zoom out, you can see all the structures that have been taken. You can see all the previous structure, all of it that's been taken out. And you can see the only structure that hasn't been taken right now is all the way up here. Okay, turn on your microphones, please. I'm going to allow all microphones to come on. Turn on your microphones. This was a bit of a longer lesson today. I've actually got a question for you. How many of you want an offline lesson? That means you want to meet somewhere one day in a cafe, or was going to book out like a Costa or something. Turn on your mics, by the way. I'm turning on all. Everyone can turn on their mics. Please all turn on your mics. Just make sure you got no background noise, no TVs or anything, but please go ahead and turn on your mics. Hello, anyone there? Talk to me if you're there. Okay, hi. I can hear good.
Hello.
Hello. Just identify who you are when you speak. But I'm thinking of doing an in town, so I'll keep mine off. That's fine, Waco. I'm thinking of doing like an offline meeting for people. If you all want to come down to one place in London, then we just knock out a day of trading or whatever. But besides that, any questions anyone has, please share.
Toby, it's Sandy here.
Hi, Sandy.
Hi, Toby, can you hear me?
Yep.
Toby, I think that's an absolute brilliant idea.
Awesome. We'll do it then.
Awesome. I personally have a problem. I'll be flying out on Wednesday for a while.
Okay.
But for the other students, I think that's an absolute brilliant idea.
Okay. Then we'll work on making that happen. Thank you, Sandy. Any other questions? Anyone stuck on anything? Everyone Hi, speaking, please.
It's Valentine speaking.
Hi, Valentine.
Yeah, hi. Thanks for all you shared today. It's pretty clear. I must admit, like it's on the ZAR was easier than the gold actually, for me, anyways.
Oh, to understand it was easier than the gold.
Yeah, it was easier for me, the ZAR, because that one was quite clear because I was following it as you were posting throughout the day, so it was pretty spot. And yeah, you've already clarified the thing about the weekly support, so it's basically just trying to pick it off the weekly charts. But my question is, when do you get in after you see the market structure breaks? So, and how do you like mitigate against? So it could go either way if you like. But are we trying to protect? Hello.
Yep.
Okay. Are we trying to protect? Like, how are we like looking at the market to try and like protect ourselves from and make sure that we stay in to grab as much value as we can whenever we see these market structure breaks?
Well, when you see a market structure break, any trade could go either way. For example, right now I posted gold. It could decide to drop right through our zone and ignore my analysis and whatever. We're trading. You always go for the most likely setup. You don't go. Nothing is ever definite, but you go for the most likely setup. I should be in the living room. Sorry, my son's here. Yeah, so with trading, you go for the most likely setup. Now you can see here for example, on this gold trade, you can see there's an intraday market structure break. It even broke yesterday's structure. Yeah. Intraday market structure break. I like the wicks. The wicks peaked above this high. Where I look to enter is actually right now, this second, when the market structure breaks and returns to the point of origin. That means when I say point of origin, I mean it returns back into the demand zone. That's an excellent place to enter a trade. Happens like, for example, this particular day. Market broke previous structure, returned back to the place of origin. That's where you look to enter. Yeah. Now, the issue with market structure break, and sometimes you'll see me, I do aggressive entries. For example, if I'd seen this earlier, I would have entered right down here, not here. I would have entered before there was even a structure break. Structure breaks are a great confirmation of intentionality. But I already know, if I already know we're in a demand zone, why do I need to wait for a structure break? Because sometimes what happens is, for example, you see this particular day, this was the demand zone. Market rose up, yeah? It broke structure right here, but never returned back to the origin. It just went off, yeah? So sometimes waiting for a structure break means you've missed the whole trade. Thankfully, when the market does wait for you, and it gives you these great positions where it breaks structure, returns to the place of origin, you should lap it up as quickly as you possibly can. That's the trade that you should be involved in, like yesterday. Now, can this trade lose? 100%. But you're going for the most likely circumstances. You're also playing the statistic game. If you're gaining, say from this trade could be a 10 to 1 risk to reward. That means you stand to make 10 times more than you lose if you hold it out all the way where I've set my target to. That means if you win this, which is a high probability setup because all the rules are in place, if you win this particular trade, you can stand to lose the next 10 trades if you risk manage really well. Because each 10 trade will just be taking, if you're doing 10 trades at 1%, that is, each 10 trade will just be taking a little bit out of this. Now, if you keep taking 3 trades at 10 to 1, you're a winner overall. It's the end of month statement that matters, not the daily statement. That's how we mitigate against the negative psychology of trading. The only way to mitigate against negative psychology of trading is to risk manage. Risk management should be set at 1%, at most 2%. But yeah, to answer your question, best place to enter is when the market returns to point of origin. That means this is your demand zone. Demand zone is point of origin or money box. Yeah. Market takes off, returns back to your point of origin. There's your first entry. You missed that. Market took off, return back to your point of origin. There's your second entry. You missed that. There's your third. It's like it's begging you. Come on, now get in. Each time the market returns to a point of origin, it's a market maker saying we haven't made enough money. So basically, remember what I said. If their intention is to drive the market $10 million up, yeah, and they've only got 5 million net short, they'll keep driving the market more and more into this money box to entice shorts. It's all about enticing shorts. If they're 10 million long and now say they got 15 million net short, now they're going to wipe out all the stops and take the market up.
Got you. That's pretty clear.
Good. Any other questions? If you've got no more questions, just type N so I'm not waiting. Just type N. Fantastic. Fantastic. Okay, what I'm going to arrange, myself and Israel will be back trading tomorrow. We've been doing a lot of investors meetings, which is why he's been out of it for a while. He's my CFO, so he deals with all the money and digits and numbers. We've got taxes to sort out and blah blah blah. I won't bore you with the details. But once all of that's sorted out, which should be sorted by tomorrow, we got our investors meeting on Wednesday. We'll be back to really giving you our full attention with regards to analysis. But also I'll be doing my manual launch, which explains everything that I'm teaching you in detail. The manual is called The Trade. It's actually available to order now on the website. A few people have already ordered it, but I'd like people to order it on the day of the launch, because on the day of the launch, I'll be teaching directly from my manual as well. But it'll also be a chance for you to meet each other as students and invite some friends along as well to the Wealth Mentor Online party, or whatever we want to call it, launch party. I'll be booking a hotel somewhere in London to do that. Also, what I want to encourage everybody, if you're not a member, if you're not with a broker, or you want a really good broker, Hot4X is a fantastic broker. You know, I don't often endorse brokers, but this one is particularly good because they do offer a quite attractive option with the zero spread account, which is great for our trading style. Oftentimes, I could post a trade and be in profit where you'll be in minus, simply because you don't have you have spread still to pay, whereas I wouldn't have any kind of issue with spread. So that's something for you to think about. The other great thing is, if you bring on new students, what I'll be teaching you is how to open up another source of income for yourself as well, which would basically mean become an introducing broker. If you become an introducing broker and you invite other people to learn with Wealth Mentor, when their accounts go live, you will become their broker, which means you get paid per click. And I think it's $10 per standard lot that somebody clicks, you get paid. So, for example, every student that I brought into Wealth Mentor who has opened an account with Hot4X, I actually get paid per click whilst they trade as well. And it's not paid from them. I get paid by Hot4X for basically being a brand ambassador and sharing and telling other people about Hot4X. I've never been scammed by them, never had an issue withdrawing my cash from them. And by the way, I've had issues with other brokers for sure withdrawing my cash. Also, some brokers that I've worked with have also done tricky things like running stop losses, which we call stop loss hunting, or slippage, or silly things like that. Cowboy sort of mentalities. Haven't had that issue with Hot4X. So it's a broker that I do recommend. If that's something that you want to be a part of, please just private message me in the group. I encourage everybody, open up a live account. I encourage it. I'm not going to say do this, because again, I'm not a financial advisor. It wouldn't be legal for me to do so. But I encourage everybody to open up a live account and put a small amount. Open a micro account, put $100 into it, and learn the discipline of risk managing with a small amount of money. You might only make 50 cents, where you'll see us make 5 grand or whatever, but you'll learn the discipline with a small account. So I encourage everyone, just throw $50 or $100 into a live Hot4X account and start trading it. Start posting your own signals like Sandy does. And Waco as well does that quite frequently. Start showing us your analysis. Draw your money boxes on your lower time frames. Draw your pivots. These red lines, I call them pivots. They're places I expect the market to turn around based on higher time frame analysis. And then show us where your lower time frame analysis is. And then I'll basically comment and say, well, maybe you should have seen this, this, or that, or I'm not sure. And make your analysis clear. Type out what you're seeing. Give us a clue into your mindset. Well, I saw that we're weekly demand. As I drilled down to a lower time frame, I saw market structure break on the 1 hour time frame. The market's now returned to origin, which gives me a strong conviction that the market's going to go north. I'm entering this trade. Stop loss is going to be here. Take profit is here. Giving me a 5-to-1 risk to reward. Done. Okay. And you can also do this. This is such a simple style of trading that you can do this on your mobile phone. Just download MetaTrader onto your mobile phone, and you can also do the exact same analysis that you see me do on my screen on the mobile phone, because I don't use anything savvy but the naked charts. Okay, Sandy, yes, I will post it. I owe like 3 weeks worth of lessons that I haven't posted. I apologize for that. Again, we've had like serious investors meetings taking place. That's just kept us mega busy. Again, final point is we are still looking for major trading talent. So we are actually looking for people to invest in still. But look, we've got investors coming in through our noses, and we are still looking for people who take on what we're teaching, learn the philosophy, and then we can bring you on as part of the Basilica Invest Lions, we call them. Our traders are called the Lions. We have a private group that no one can see on Slack, where all the traders talk about the and they come on basically as junior traders first. If you do well as a junior trader, your pay goes up once you become a senior, and then you become a partner. Right now, we only have one partner, which is Israel. So we're looking obviously to bring on more. So please work your socks off, even while you're at your job, during your lunch break. This is how I got out of my job. During my lunch break, I'm analyzing. Um, I don't suggest you this, but I went as far as downloading trading software on my work computer. Well, I didn't download it, it was online. I found an online MetaTrader and connected it to my live account. But as long as I was on lunch break, people knew Toby's in the zone. He's trading, he's not, or he's reading up on something, he's learning something. You want to make a career out of this, you want to make a life out of this, you want to make a living, take it really seriously. It's not a hobby. There are cheaper hobbies to do where you won't lose as much money. Please take it really seriously. Learn the stuff. I'm giving it to you guys for chicken change. Stuff that should be worth thousands of dollars, I'm giving for next to nothing. £25 a week is nothing for the information we're giving. So please don't take it for granted. Please get stuck in, and also invite people. Tell people about us. Share our Instagram page if you can, and let people know. Would love you guys to be brand ambassadors. Have a fantastic evening. God bless you. A great day trading tomorrow. This gold trade should be nice and should deliver us some good profits. Talk to you tomorrow. Bye bye.